Good afternoon, and thank you very much for joining our this afternoon's webinar with the Tipton Building Society. I'm delighted to have with me today Richard Groom, who's Head of Mortgage Sales. Thank you for joining us, Richard.
You're welcome, Dale. Thank you.
And what we're going to do this afternoon is Richard's going to go through some of the reasons to use Tipton and some of their successes in case studies. At the bottom of the screen, you have got a questions and answers. You can submit a question, and we'll try and answer that as we go through the presentation. But right at the end, we've left 5 or 10 minutes anyway. Once Richard finishes his presentation, for us to do some Q&As, and I've got some questions that I want to ask him as well. So, in the meantime, Richard, if you want to proceed, and then we'll touch base a little bit later on.
Yeah, thanks, Dale. Welcome, everybody. Thank you for taking your time out of your day. I know everybody's exceptionally busy at the moment. So as Dale's alluded to, today is just to give you sort of a generic overview of the Tipton. It's probably a name that some of you may have used. Quite possibly it's a name that you've seen, but you know very little about. So hopefully I can address some of that with you. What I would suggest is early on, I just wanted to pick up the fact relating to COVID, because with lending, as you'll all be aware from last year, it has had an impact. The market's never been busier. I don't think any of us probably predicted that going into lockdown 1, but it's certainly the heat hasn't come out of it at all. But there are implications for lending, and I thought I'd just share what Tipton's view is, because I know for yourselves, it's sort of trying to understand what's one lender's interpretation compared to another's. Now, very much from Tipton's perspective, we're a little bit more flexible early on, but obviously as it's been over a prolonged period, if you're looking at employed applicants, we're currently not able to accept somebody who is currently furloughed. But the moment they've returned to work, we can certainly consider them suitable for mortgage application. So we just need that certainty that return to work, they're back in full-time employment. There are some contract terms where now they're on flexi furlough. We welcome and open-minded to consider those on a case-by-case basis. We actually had success with one of Impact's cases recently where their client had returned on a flexi furlough contract, but it was only a small reduction in hours. And as a consequence of the terms of the agreement, he was able to cover that with holiday pay. And that was actually lending on our high income multiple proposition, which is something we can allow flexibility on, and you can gain access exclusively through packages such as Impact. In terms of self-employed, obviously now that is a challenging area for everybody. I think lenders, brokers themselves, obviously only this weekend, there's a lot of press regarding the decline rate associated with self-employed. So if I just set out our sort of starting position, but as a manual underwriter, you'll appreciate virtue more than ever, it comes down to the individual circumstances of your client's case. First and foremost, we are still and have done actively throughout COVID supported self-employed applications. What's interesting on that point is, whilst it is more difficult and obviously different people are being affected by COVID, for those who've struggled, there's many businesses have thrived. So we're certainly open-minded to continue. But what we have to acknowledge as a lender, it's not as simple as perhaps in the old days or even last year in 2019 of looking at the most recent set of accounts and jumping to the assumption that that business will continue exactly as it is. So in terms of COVID, our self-employed requirements are, we will accept them. We do need to see at the very least a 2020 tax return. They must have submitted that to give us a clear understanding of what their income pre-COVID period was. We then need to verify and be able to ascertain that the business hasn't been impacted by COVID by requesting business bank statements. We look for the latest 6 months. And what we're looking there is just to see that there is regular turnover. And obviously we've got commentary and we have dialogue with the accountants to support, to give us a true picture of what's happening with that business, to enable us to give us some sort of confidence that that business is still trading successfully and is viable, and that we're being responsible supporting that mortgage application. I know one of the things that have been a bugbear or a change of approach or different attitude within the lending market, depending on one lender, is obviously the support that is available to self-employed through the various government initiatives. So from our perspective, certainly the grants that have been available, the contingencies that somebody in self-employed might have taken, often at the advice and recommendation of the accountant, we will accept and underwrite against. In terms of the more extensive bounce back finance that's available, it is down to the case-by-case basis. What we need to see is that it wasn't for rescue purposes. It's not because there is significant shortfalls in the business and concerns, that perhaps it is for that contingency period. And definitely in those circumstances, we're not looking for that type of finance to support the house purchase or move. So if somebody is a purchase and we're seeking proof of deposit, we would expect them to be able to demonstrate that that's not the source of that deposit, isn't coming from one of the government initiatives, but was there to support the business. So hopefully that gives you a little bit more understanding of appreciation, particularly on self-employed, which is challenging at the moment, to pick up the phone and consider ourselves in those sort of circumstances, particularly if it's something that mainstream lenders have not been able to support you with. Computer credit scoring, obviously it's a big part of what Tipton does. If you're not familiar directly with Tipton, you've probably got existing relationships with some of the other building society peers, such as Mansfields and Hinckley and Rugby's and the difference. And whenever you speak to a head of sales or a BDM from one of these firms, it's always about the manual approach, no computer credit scoring. So just to put a little bit of colour around that so it makes a bit more sense to you. First and foremost, we're not an adverse lender. We're not into the subprime market. We're probably quite conservative, but at the same token, we are more flexible and we can consider the case for its merits. So we're looking at people perhaps with a financial blip or a small amount of debt or adverse link to them that was historic. But in those circumstances, even at high LTVs, we are still open-minded and can assist. And these are very much cases that you've probably, on a sourcing system, have gone with high street lender and found that the computer says no. And once you get that outcome from one lender, you will find often that can be repetitive with a number of lenders, particularly if you're working down the best buy tables. So from Tipton's point of view, late payments considered status or 1 of 2 on an account within the last 24 months will still be considered. The cut-off for us for somebody who's gone to status 3. So they've had 3 consecutive missed payments. For us, that's demonstrating that there's more of an issue than an oversight. Defaults are considered up to £500 as long as they're being satisfied for 3 months. We may consider a default over £500, but the rest of the case must have substantial merit and there must be a genuine reason of why that's occurred. And once again, it has to be satisfied. And equally, people with payday finance, it's something that didn't exist really on credit reports some years ago. If it's historic, it could be associated when they were a student, it's not reflective of how they live their life now, then it is also something we're still open-minded to consider. But it is manual underwriting. So what does that mean? You could present a credit report for me where nobody has ever exceeded a status 2 in the last 12 months. But if it's repetitive and reoccurring on various accounts, then it's highly likely that the outcome is going to have more question, more underwriting. And if it's held high loan to value, it is quite likely that we reserve judgment and not assist. But then there's other scenarios where it's just occasional blips or small default, there's an explanation that we will certainly look to consider and progress forward. It's standard underwriting and we can support that even on our high LTV lending. We touched on self-employed and how we can support them and will continue to support them in this lockdown period and this extended COVID. Hopefully there is light at self-employed. Is we will look at latest 2 years income figures. We can even factor a projection in to support an increase in profit, very much having dialogue and support from the accountant providing those figures. If it's a limited company, we do underwrite purely against salary and 100% of dividend. Sole traders, it's a tax year overview. But once again, as I said, that's bear in mind the COVID additional requirements, which are quite reasonable, and I'm sure you appreciate and understand. Over and above any accounts information they're supplying, we will be asking for those business bank statements and potentially a projection or management accounts if it's a limited company. Just to, if we're open-minded and willing to support these people, we just need the accountant or the customer themselves to be able to demonstrate what they're verbally telling them so that they give the confidence to the underwriters to sign off that case. Particular niches that in all my time at Tipton has served us well is our approach in what was originally CIS, but we actually brand long-term subcontractors because it isn't just restricted to the construction industry scheme, CIS workers. And this is our ability to consider them almost on an employee basis lending against gross income. So in the old days, it was very much, it was bricklayers on building sites, it could be plasterers, but we've got no restriction about the industry type. And you do find people in this situation now. I've lent, in these circumstances, social workers, IT workers, well, almost any walk of life. But there is a distinction here when we reference long-term subcontractors compared to fixed-term contractors. So these are people, essentially, they're probably as employed as I am. They go to the same place of work, doing the same job. It's just that they're on contractor terms, and so they're responsible for their own tax and NI. There is no formal contract in terms of it's a fixed 3-month period or 6 months. It's not fixed term. And what we're looking for is just certainty from their employer, for want of a better phrase. It'll confirm that the relationship is ongoing for a foreseeable future. There are a few lenders in the scope who apply a similar approach, and it's worked really well for us in the past. An excellent case study that I've used numerous times, just because it just demonstrates the simplicity of it, and also where borrowers can miss out, was an IT worker from Coventry direction, who had actually been running IT and employed by the firm for a period of 4 years, PAYE, and consistently earned. And at the end of 1 year, tax year, there was a suggestion by his employer to switch on to a contractor basis. There's tax advantages that are considered for both the employer and the employee, and he took advantage of it. But unbeknown to him, as him and his partner were renting at the time, when he started looking for that first purchase and approached estate agency-based mortgage brokers, it became very apparent that the majority of lenders, particularly on restricted panels, were considering him self-employed. And as you'll all well know, less than 6 months, less than 12 months, just self-employed does limit that appeal in the marketplace. Even the real challengers and specialists in this market in self-employed would look for 12 months figures. But if we just step back a bit and think about that client's circumstances, he worked at the same desk, doing the exact same role that is PAYE, earning a gross income of over 50,000 for 3 years previous. Nothing had changed other than the employment terms. From our perspective, to gain that confidence, not only had we got that backdrop of P60 figures, we'd also got an employer who'd certainly confirmed the gross income we'd received, that the relationship was ongoing, that there was no danger of any concerns. We knew he'd been there more than 6 months history. And so from that perspective, we were more than comfortable with underwriting against the gross figure compared to somebody, even if he'd been trading for a period on this basis and considered self-employed of using a net income off any tax returns, we were comfortable to lend against the gross income. And the outcome was which, on this particular estate agents with a limited panel, none of the other lenders on their panel was able to offer anywhere near the amount we could. And it secured a mortgage and a property for this buyer, who the best advice they'd had as an alternative was to continue to rent until they got at least 12 months accounts. So I think that's an excellent example of where that type of approach can just offer the clients a different outcome. We also have what we consider our high income multiple proposition. Now, this is very much packager exclusive, so I'd encourage you to refer anything through to Dale's team. Kelly's very familiar with our deal. It enables us to lend up to 6 times. So as a lender, our standard multiple and the whole of market multiple is 4.49 times single and joint. Very similar to market norms. But we can consider cases where we'll go up to actually a 6 times multiple. It's maximum 85%. It is always capital interest, available for purchase and remortgage. But let's be clear. In my opinion, LTI is pretty much old money. It's very much old regulation where you calculate an LTI, their ability against an income multiple. It's not actually reflective of the financial circumstances of that client. What's their age? What debts have they got? The old-fashioned LTI doesn't calculate that. That's why we consider we're being responsible, and there are certain appetite and certain people who can afford more than that very much generic 4.5 times multiple. So it is case-by-case basis. It is subject to seeing the underwriting of the case and a full affordability assessment. To put a bit of colour around it, realistically, you are looking for perhaps more the professional market, people who are earning 40,000 in excess. But we used to, in many years when running this successfully, where we started with a minimum income of 50,000, we sort of cut that away because you could have one borrower who earns over 50 with a second borrower living at home on no income compared to 2 people looking to purchase where they both bring 40,000 gross salaries. So once again, we stripped out any limits to make it very much down to the individual assessment of the case. But if you have got somebody in the professional market, as I say, probably at least one earner over 40,000 plus, once we get an understanding of their age, which affects the term, their lifestyle in terms of any committed debts such as loans, school fees, etc., 6 times is achievable with ourselves, and that is at 85%. But as I stress, that is very much through package relationships, and it is something that I'd encourage you to reach out to Impact and their team if you think you're struggling with mainstream lenders, particularly on credit scores. I'm well aware that now 5 times is available in the prime market, but once you start going over 5 times, options do become limited, particularly if you need that comfort of a bit more of a manual assessment to the case. So certainly give ourselves consideration and utilise Dale's team, Kelly and Holly, for those sorts of inquiries. What we have been running for many years is 100% Family Assist. And I'll be perfectly frank, in normal lending terms, pre-COVID, it isn't something I focus too much on the intermediary. It's always been one that we've done quite well through the direct channel. But in normal market conditions, as intermediaries, when you've got a whole scope of 95% availability and 90%, the need for this sort of alternative isn't as strong. But previously, a financial crisis back some years ago, it was sold very well through the intermediary channel, and certainly we found that again in the last 12 months, because it does create a clear second option for borrowers when we've seen the lack of 95%, and it's only within the last few weeks that 90% lending's returned. Essentially, without going into too much detail in this brief summary, I'm happy to take any questions at the end. Think along the lines of Barclays Springboard. It operates very similar. There's 2 alternatives. They've got a cash or collateral charge option. So the parents can deposit funds with us to stay in a savings account to cover 20% of the borrowing, or we can take the similar level of amount as a collateral charge, because we actually acknowledge whilst some parents can be asset rich, it doesn't necessarily convert directly into cash rich. So we've got the collateral charge option, which is slightly different to Barclays in addition to the cash. But our scheme then enables them to either borrow up to 100%, or they can actually put a contribution themselves and borrow down to anything down to the conventional 90% lending. Once again, we're seeing some movement in this market where there's more options, but still there's hardly any availability of funding funds on outside schemes such as this without at least a 10% deposit. And then you are very much, whilst there's new 90% products coming to the market, they're very much in the prime territory, full credit score, where having a family assist option with support from the family member in the background can be a really strong way of looking at it slightly differently. And it's all about giving clients options and to stimulate the housing market to a certain degree. But it's served its purpose in the last 12 months. It's been well received. Along the same lines, I've just thought I'd throw the JBSP because it's now becoming even more and more prominent. Obviously, it's a scheme that's sort of rose to the surface over perhaps the last 18 months. We launched our proposition just over 12 months ago. It does help from the mutuality from point of view where we often get involved with multiple generations being involved in purchases. It's adding that family member to support affordability. And essentially, in the straightforward terms, it's son and daughter and their partner might be looking to purchase a property, first home, and unfortunately affordability isn't as strong. And with the lack of guarantor solutions in more recent years, joint borrowing is that alternative option where we can start utilising the parents' money, parents' financial circumstances to increase their borrowing capability, but without the parents being associated with the mortgage incurring any additional stamp duty levy. So it is a growing sort of scenario for us, and we actually will flip it the other way around as well. We've done a number of cases through our later life product stream where we've actually seen it's the children supporting perhaps an elderly parent in their final purchase. So we can flip it around. If we are lending past the parent's age, state retirement age, it does cap our LTV to 75%. But if they can run to a term that will stop at their state retirement, which we consider as 70 for employed or 75 for self-employed, then we will consider loans even at 90% when we've got products available, or 85%. I've touched on lending retirement. It is a part of what we do. We're a lender that will consider mortgages when we're lending in retirement, so they're already retired and underwriting against pension income. We'll immediately take their age up to the age of 95, maximum 75% loan to value. We'll also allow associated with that interest-only borrowing. If it's interest-only without a repayment vehicle, the LTV we deploy would be max 60%. But we can avoid what we always term as a death stress association with that ability to can the second or first borrower afford the mortgage on their own provision in the event of the death of either party. If there's more than 200,000 equity, which is sufficient in their location to purchase a property of at least a 2-bed apartment, we can offset that requirement to still support. If they have got a repayment vehicle and want interest only, then we would go back up to 75%. In these circumstances, quite often when you're lending in retirement, if there is other occupants of that property who aren't part of the mortgage, we would insist that they take independent legal advice. But the lending market and later life market is one that is just significantly growing and will only continue to do so. And I think lenders of our size are probably in the build site community of being at the forefront of lending in retirement and keeping the options open. And essentially, if we can demonstrate that underwriter, that pension income and that provision, or we can make judgments against sick values and drawdown pensions, they are good risk. And obviously there is a need in the economy and there's a need in the mortgage marketplace to have more options for those in later life. Supplementing that is our retirement interest only proposition. We were one of the first build sites to move into this. Now, obviously, I'm sure you've picked up some marketing and press around retirement interest only, and some of it has probably been negative in terms of the people it's been served or being able to support. From our position, it is just one of the sweeter changes that needs to be in there to give later life customers solutions and options available to them. It sits neatly alongside equity release and the move to do more standard lending in retirement that secured lenders. Retirement interest only isn't a silver bullet. It's not a perfect solution for all, but often it can be a stopgap before people do need that equity release. It does allow a 60% LTV. And the difference between our RIO proposition compared to later life is the fact that there is no term applied. It is a mortgage for life. We also are more flexible about capital raising purposes, so they can capital raise, and it could be for gifting to family members for whatever purpose, up to 25%. But as a regulatory requirement of RIO, we do need to establish that the mortgage will remain payable in the death of either borrower. So you may be an inquiry that starts with us on RIO, and if we can't satisfy that, if there's equity there, it may be that we have to move you across the standard later life range, which would have a term apply, but it's all about giving options and trying to find solutions to the customers as they approach later life. So it's not a silver bullet. There are certain criteria that needs to be met to satisfy the regulatory rules associated with RIO, but we've certainly seen a growing number of cases that have fit good quality lending, and the big winners for later life the people who get peace of mind that perhaps have come to the end of a mortgage term with a prime lender, aren't in the position or want to trade down at that particular moment in their time, and it just puts control back to them so that they can make the decisions that suit them at the time that suits them in the future. That hopefully gives you more of an appreciation. Webinars are always difficult because obviously I can't maintain eye contact and pick up as we go, but you are welcome to ask any questions that may pop up. I'm sure Dale's got some. But the essential bit about Tipton and Cozy is we lend in England and Wales. We don't credit score, so it gives a lot of manual underwriting opportunities. We have certain exclusives that partner with Impact and you can use to your advantage, such as high income multiples, and we'll have expat buy-to-let to come in the future and other opportunities. And we've got a strong later life proposition. So hopefully it's been of interest to you, but I'm open to take any questions you may have.
Thanks, Richard. That was really excellent and a really good insight into the Tipton. I've got a couple of questions, first of all, just regarding, obviously we're in nearly a year into COVID. How are your team coping? Are they all working from home? What's your SLAs at the moment?
Yes, certainly. No, I think it's a valid conversation with the challenges lenders had last year. We've probably now got across the business about 75% capability of remote working. Without a shadow of doubt, we were challenged service-wise. I'm not going to dismiss that like every lender. Particularly, to our credit, we continue to lend throughout. We did what we have done as a consequence. We did have to pause lending a couple of times during because of the balance between getting service and availability of mortgage products. And it's sort of right, and it also gave us the opportunity just to review. So as a consequence of lessons learned last year and bringing in a more solid remote working, we are in a much stronger position now. We've streamlined the process that we apply. We've actually recruited. It wasn't the sole solution, but adding more personnel has supported that, and that recruitment continues. And we're now in a situation that we manage tranches. So we use exclusive limited distribution using our partnership Dale to manage the flow of business. Because one thing that caught out lenders our size, you have to accept, we are a small lender, and when the biggest lenders do drop out, we aren't strong enough to pick up that capacity. So we have to be sensible and prudent about what we're offering, but maintain, because that balance of service. What I would say, and I'm probably speaking on behalf of all peer group lenders our size, the brokers can play a massive part of this, because as I've talked through, we're a manual underwriter. And what we do find is half the turnaround time is taking on the packaging requirements. Now, as part of our improvements, my team will give a broker exact DIP approval terms, spell out exactly what documentations we need. And it's nothing fanciful. It is the standard 3 months pay slips, bank statements, and that sort of documentation. But that is absolute central to the end result of how quickly that offer comes. And what we're now already seeing is we're getting sub 21 day offers out. And those are cases where we've had the packaging quite quickly. And the cases that end up with a total turnaround time from when the brokers press that button to submit to when the offer is issued, often we've lost 14 days where we're still waiting for certain documentation to come, or it comes bit parts. You'll get the latest pay slips, but not 3 months track record. So I think we've learned lessons, we've improved, we continue to make progress in those changes, but I can't stress how much the broker plays a big part in that for us as a manual underwriter.
Absolutely. And we find that as well, and that's part of working together with you to make sure that case is offered as quickly as possible. The questions come in regarding stamp duty. Are you still taking cases? Do you think you can still turn around cases in time to meet the stamp duty deadline?
We have, because of the pipeline reducing down, currently we are servicing and getting applications out within a 14 to 20 day period if they are well packaged. We obviously can't make any guarantees because it's the next side of conveyancing and the chain itself. We were very conscious to make sure that we got a strong pipeline and did a lot of lending Q4 because we didn't want to be chasing business in Q1. We wanted to be sensible about capacity. But we certainly have got the ability to service and lend at the moment, but it's very difficult for a lender to come out and put a condition to say this will guarantee completion, because as we all know, there is other layers to that, and it is difficult.
I think it's going to be a busy last couple of weeks in March, from what I understand, and there's quite a few people that may well miss out. Just one last question, then. I've got a couple of minutes left. What's next for Tipton, and where do you see the rest of this year panning out?
The next main thing we're looking for, off the back of our success of going into expat, is foreign income and residential expat. So I hope to have a proposition out, which we'll probably pilot initially through yourselves and similar specialist lending, but then to move on with confidence. So that's foreign income and residential expat, which is something I've been pushing for some years. In terms of the wider market, as we were talking before we come on live, Dale, I think the heat hasn't dropped out in any way. January, we suspected it would to a degree, but it's still running hot. We're trying to take advantage of that, but monitor capacity levels and make sure that we can honour our service levels. I think nobody's quite knows what the rest of the year has. I think come March, post furlough, the vaccine should give some confidence. I think trying to be optimist, as anybody in sales is, and glass half full, I think vaccine is obviously a positive sign. I think this isn't going to be a financial services-led recession or crisis. I think if there is a vaccine, there will be a quick bounce back that should help, but it's that unknown territory in the middle bit that we are very much uncertain. I think there's nobody got that crystal ball really to predict. No. We're confident that at the moment the mortgage market has been robust all the way through. We've served very well, and I think we've all agreed there's been industries that have been suffering greatly in the lockdown period, and we've survived, and I think the brokers have prospered. And so it's making the most of it in the early part of the year and then being strong enough to bounce back when that bounce back obviously will happen.
Brilliant bit of positive to end on as well. Richard, thank you so much for your time. Really appreciate it.
No problem at all.
Thank you, audience, for watching. Really appreciate your time, taking the time out of your day to join us. If you want to speak to the team, the telephone number is on our website, or it's 01403 27 26 25 to talk about anything with regards to what you've seen today and new inquiries. In the meantime, this is recorded, so it will be put up on the website shortly, and we will do another one of these shortly. So take care, look after yourselves, stay safe, and we will speak to you soon.